Guys, what I'm about to show you is not ready for you yet. You will not believe the numbers that this brand new market cap multiplier model gives us when we run XRP through it. Forget about all the other stuff for a moment. When you see how a few $1 billion entering XRP could send its price through the roof, you'll know why Wall Street banks and ETFs are lining up to get a piece of it. If you believe that $5 or $10 XRP is a long way off, this tool will change your mind. This isn't advice about money. Before I get into the numbers, I want to say this quickly. Brad Garlinghouse recently talked about how XRP futures contracts on the CME are the futures product that has grown the fastest in the history of the exchange. It's faster than Bitcoin, Ethereum, and Solana. Those aren't small traders. Those are organizations. The CME has more institutions than any other market in the world. And the fact that XRP is at the top of their charts makes one thing very clear. There is more demand from big players. This is what most people miss. The number of futures doesn't even touch spot XRP. These aren't the trades that you and I do on Chain or Coinbase. This is how big funds and banks can get exposure without having to worry about wallets, ownership, or compliance issues. The fact that big players are already getting in at record rates tells us where the money is going next. ETFs are now added. It is expected that spot XRP ETFs will bring in between $8 and $10 billion in their first year. Take that in. A lot of money is pouring into an asset that has one of the obvious uses in the real world right now. That's not like Bitcoin, which banks mostly see as a hedge. With XRP, on the other hand, you can settle payments, get cash, and do institutional grade banking. Wall Street loves that kind of story because it fits right in with how they already spend. Assets that are useful and in demand in the real world. One of the biggest myths in crypto is that investing $1 billion will lead to $1 billion in market cap growth. This is where the new multiplying tool really shines. It doesn't work that way. The truth is that every new net dollar of demand drives the market price much higher than the dollar's face value. This is because of how order books, liquidity, and supply work. With XRP, we're seeing increases of over 100. One example is that XRP's market cap is about $150 billion right now. But that doesn't mean that $150 billion has been put into XRP. Not at all. That's a small amount of the real cash that was invested. The market cap can grow by 150 to 1,000 times for every dollar that comes in. Amazing things happen when you run this through the model. I'll show you some models. XRP's market cap could go up by almost $600 billion with just one $430 million buy from a medium-sized firm. For that amount of money, one XRP token is worth about $10. Take a look at that. In a market where trillions of dollars change hands every day, a single $430 million buy could push XRP to $10. In that case, the multiplying effect is very strong. Now make that bigger. When we talk about billions, what happens? XRP's market cap goes over $2 trillion with a $2 billion inflow, which is easy to do through ETFs or a combination of institutional investment. That's $35 worth of XRP. We're not talking about anything crazy either. The amount of money in question is easy for BlackRock, Fidelity, Vanguard, or even a few area banks to give away. That's not all. If you add up $7 billion, which is what experts already think ETFs will bring in their first year, you get XRP close to $80. Take a moment to think about what that means. $7 billion isn't even a quarter of what some single funds handle. Nothing in the big picture of the world's capital markets. Still, that much is enough to send XRP to heights that most people think are impossible. Keep in mind that this doesn't even take into account the trillions of dollars that move through Ripple net routes, the use of XRP by central banks, or its role as a bridge currency. This is only the result of capital coming in multiplying things. That's why this tool opens your eyes so wide. Real numbers show what happens when a lot of money gets involved. But let's look a little farther away because the bigger picture is important. Layer 2 solutions and sidechains are still not working for Ethereum because it is having trouble growing. Hugo Fillion recently pointed out the problem with this whole model. If something is important, it should be a layer 1 and not a layer 2 that is tacked onto a broken system. That's where XRP really shines. On the XRP ledger, all assets are local. At the base level, every exchange is quick and easy. It didn't follow trends like NFTs or joke coins did. They made the network as simple as possible so that it could handle institutional banking right away. That's why communities that use Ethereum are moving away from them faster. At the moment an app really takes off, Ethereum slows down, costs go up, and workers have to leave. That doesn't happen with XRP. It was built to be big, fast, and efficient. This is exactly what institutional buyers want. When you add XRP's technical advantage to the fact that cash flows can make a difference, the case is clear. It's not just store speculation that we're talking about. The base can hold trillions of dollars in real value, and the market is set up so that billions of dollars in new money can cause the market cap to grow by tens of trillions of dollars. The best part is now here. It's still early. There hasn't even been any real institutional distribution yet. There aren't any ETFs out yet. Futures are just now becoming popular. The CME data tells us what takes place when these doors open. XRP becomes the fastest growing product right away. There is a huge hunger that will only get bigger. Think about the numbers people use when they talk about triple-digit XRP goals. They're not just making them up, they are making plans based on the real multiplier effect that appears in the market for XRP. The inputs are not very optimistic, several hundred million or billions of dollars. The results are also very impressive. We're going to keep breaking that down because this tool shows you events that will change the way you think about how much XRP will cost in the future. Let's keep running this through the multiplier because this tool really shines when you use it with more than just the first wave of ETF money. Don't forget that the $7 billion we looked at earlier was only based on how much money we thought ETFs would flow in the first year. But the money given by institutions doesn't stop after the first year. It builds up. If you've looked at how other ETFs grow over time, you know that new money doesn't just stop coming in. They speed up as more people use them and more funds have to keep up with the competition. What happens when the money keeps coming in year after year? Run the model with a total inflow of $15 billion, which is again a very realistic number when you think about demand around the world. The multiplier makes XRP worth almost $150 per coin. That's about $11 trillion in market value. And now comes the important part. It may sound like a lot of money, but in the world of capital markets, $11 trillion is only a tiny fraction of the total. The world's bond market is worth more than $120 trillion. World derivatives, $4 billion. When you look at the big picture, $11 trillion is just a rounding error in the world that XRP is trying to service. Let's go one step further. Think about a world where big financial institutions and central banks use XRP not only as a speculative asset, but also as infrastructure, payments, providing liquidity, settlement rails, and the real plumbing of the global financial system. So money comes in from more places than just ETFs and big portfolios. It comes in from people who find it useful. It doesn't matter if the money coming in is for practical or speculation reasons. The multiplying effect still works. A dollar is a dollar, so as the number of settlements goes up, market cap and capital efficiency both go up. Let's pretend that $50 billion comes in. Of course, that's still a very small part of what the top asset managers control, but the ratio makes each XRP token worth more than $500. Market value, less than $50 trillion. At this point, XRP would be worth about the same as gold around the world. That may sound like a huge jump, but it makes sense when you think about how much gold is worth and how XRP is built to allow instant settlement across borders. Gold stays put. XRP does. Gold doesn't make international trade possible. XRP does. Institutions know the difference, which is why they're waiting in line to give out. It's very clear from the model. Most people think there is a big gap between where XRP is now and where it will be in 3 years. It's not if, but when, because the multiplier does all the work once the money starts to come. And unlike most digital assets, XRP's flows aren't affected by stories or hype. There is a real-world use case for them and a clear desire for them. That is why it is so important to have the CME futures statistics. Institutions aren't putting money into a joke, they're putting money into a tool they know they'll need. Let's talk about the multiplier's workings in a bit more depth now. Why does a single dollar make the market value go up by so much? It all comes down to the amount of cash. There are times when not all tokens can be used. A lot of XRP is locked up either by people who don't want to sell or by things like Ripple. In other words, the amount of liquid is much less than the total amount of stock. Prices move quickly when there isn't much money available to buy. When you multiply that by billions of dollars in new money coming in, you get the kind of exponential growth in market cap that this tool shows. This is a useful way to look at it. Really think about real estate. When a rich investor moves into a small neighborhood and pays a lot of money for a few homes, the market value of the whole neighborhood goes up right away. All of a sudden, every property is worth more, even though only a few were actually sold. The same is true for XRP. $1 billion changes the value of all the tokens in circulation, not just the ones it buys. That's why the market cap numbers go up so quickly. It's also easier to see why organizations are interested in XRP the more you think about it. They understand that they do not need to control the whole market. They only need to find a position that can grow as more people accept it. A small amount of money put in at the beginning is worth a lot more as more money comes in. The multiplying effect is so great because it does that. It pays off a lot more to position an organization early than late. Let us add one more thing to the mix: setting rules. With more clarity coming to key markets, XRP is in a unique situation compared to other assets. Even though Bitcoin has ETFs, it doesn't have a natural use besides being a way to keep value. There are still arguments about whether Ethereum is a security, and its plan for scaling is still unknown. XRP, on the other hand, was designed to be used for business settlement. When regulations are clear, institutions can step in without thinking twice, and when they do, the flows we're modeling here happen. Let's talk about speed. Inflows do not happen by themselves. When institutions start to give out money, the market gets a message. Things pick up speed, ETFs get money from regular people, and foreign funds rush in to make sure they don't miss out. It's like a chain reaction. The model we're using is a straight line. The real world is exponential, but you put in billions and see what comes out. The purchase of one institution leads to the purchase of another. One flow of ETFs leads to another. Soon the flow won't be counted in billions, but in tens of billions. And the numbers which show this are truly amazing. Imagine getting $100 billion over the course of a few years. Even though that sounds like a lot, it's still less than 10% of the money that Bitcoin ETFs are expected to get in the same amount of time. What about XRP? That much would put its market value into the hundreds of trillions of dollars, and each token would be worth thousands of dollars. Don't worry, it's just math again. In black and white, that's what the multiplier tool shows us. Because of this, we can't just talk about how much XRP will cost in the future. People think in small amounts when they see $0.50, $1, and $2, but XRP's setup, along with institutional demand, makes jumps into double, triple, and even quadruple digits possible. And everyone doesn't have to wake up at the same time. It only needs steady money coming in from the same companies that are already buying futures and waiting in line for ETFs. Now think about one more thing. It's not just money that ETFs bring in. They also bring authority. As a financial class, they make XRP more real. Large groups like pension funds, endowments, and national wealth funds are limited in what they can do, but ETFs change that. They give these funds the legal tool they need. When those doors open, money comes in like a flood. That's when the multiplying effect turns from an idea to a real thing. What does this mean for us now? The multiplier model shows that even small amounts of money can have huge effects. In CME futures, institutional buying can already be seen. Expect ETFs to bring in billions of dollars in their first year alone. Also, global banking has a lot of money that is much bigger than anything crypto has seen so far. When you put those pieces together, you can see the way XRP doesn't need a lot of money right away. It only needs a lot of money because those billions are enough to set off the multiplier and change the prices of all the goods on the market. Right now, that's the way things are going. We've looked at how the market cap multiplier works and seen how billions of dollars in new money can quickly lead to values of $1 trillion. But here's the important part that most people miss. The market doesn't move in a straight line. They go in waves. When people start buying XRP, the price won't change just once and then stop. New money comes in at every new level of acceptance. That sets off the next breakout, which forms a feedback loop. This is what Bitcoin showed us. In the beginning, small amounts of money came in and grew it from pennies to hundreds of dollars. It then rose to the tens of thousands as more money came in. Every wave built on the one before it. The idea behind XRP is the same, but there is one big change. XRP is useful because it was made that way. That means that once price action makes news, adoption in the real world speeds it up instead of slows it down. Let's use the multiplier on a few very bad cases now. Imagine that $250 billion keep coming in over time. Again, if you're only thinking about shopping, that might sound like a huge amount of money. That's less than what U.S. retirement accounts put into bonds in a single quarter, though, to give you an idea. XRP goes through the model and soars into the several $1,000 area. We're talking about market caps that are on par with the biggest asset groups in the world. Push it even more. Imagine that $500 billion comes in. It's only $500,000. That's not even 1% of the world's stock markets. I think that at that point, XRP could go up to around $7 to $10,000 per coin. These are not just wild ideas. We've already seen the liquidity and multiplier effects play out on smaller scales, so this is just math. Don't forget that this isn't just about speculation. This is about how XRP can be used as a bridge asset in a new banking system. When big banks and central banks use XRP to settle deals, provide liquidity, or make it easier to send money across borders, that's a type of inflow. The multiplier works the same way for every settlement corridor and deal. Now, some people wonder if the multiplier effect could be weakened over time by liquidity depth. That's right, but only at very high levels. When money comes in early, it has the biggest effect because there is less liquidity and more supply. As the market value of XRP rises into the trillions of dollars, the multiplier starts to slow down. But by that time, the prices are already through the roof. It's just how growth works. The most important thing is that the multiplier is at its strongest in this phase, which is the establishment phase. This is the exact type of money that came in early and hard. ETFs, CME futures, and bank orders. That's why time is so important. The model shows how quickly things can get worse once capital starts moving. We're on the edge of a reversal event. Think about what happens when a lot of triggers come together. First, the US government gave the go-ahead for ETFs, then European regulators did the same, and finally groups in the Asia-Pacific region stepped in. Each area sets off the next. When you add in the rising number of settlements from RippleNet partners, you have billions coming in from both speculation and use. All of that is taken care of by the repeater. This is why it's so important to stop setting small straight-line price goals for XRP. A change from $1 to $2 or $2 to $5 doesn't show what's really going on. The real story is about how things grow. It's called step function growth, and it happens when new pools of capital change the values of things almost overnight. That's how powerful the multiplier effect and institutional acceptance can be when they work together. It's not just the price either. More credible values are those that are higher. Credibility brings in even more money. When XRP hits $10, it becomes a real large cap asset that banks can back up. When it reaches $100, it is as important to the economy as traditional goods. It's an important part of the world's banking system and worth $1,000. The stages of growth build on each other, making a circle that keeps going on its own. Just think about how markets work. Small buyers look for news stories. Institutions try to get orders. When pension funds see what other pension funds are doing, they do the same. SWCs move their money around when they see that ETFs are doing better than expected. It's not good for banks to fall behind when rivals use XRP corridors to lower settlement costs. Adoption spreads like snow, and the multiplier effect speeds it up every step of the way. It's not the right question to ask whether XRP can hit double, triple, or even quadruple digits. The right question is, can it? When does the cash flow become easy to see? That's the right question. The model shows us exactly how those numbers are reached once the flows begin. Now, things really start to get interesting. To get to these numbers, XRP doesn't even need to control most of the global flows. Just slivers of the huge bonds, swaps, and foreign exchange markets are enough to provide a small amount of global liquidity. That's because the multiplier makes each input worth a lot more than it really is. In simple words, let's say, think about a small river that flows into a dam. That river might look small by itself. When the dam lets the water out, though, the force is huge. The same is true for XRP's market cap. When the multiplier fully kicks in, a small amount of capital turns into a flood of valuation. And this is just the start. Digital assets are moving from the edges of the financial system to the center, which will cause a huge change in the next 10 years. The companies that get in early will be the ones that take advantage of the exponential benefits. These changes are happening quickly, and XRP is a key part of them. It has a unique mix of usefulness, efficiency, and institutional focus.